Global silver markets are closing the week under significant structural pressure as key inventory data from major exchanges reveals a widening gap between deliverable supply and outstanding futures contracts. At the center of this developing story are three major data points that market observers are tracking closely heading into the new trading week: registered silver inventory levels on the COMEX exchange, the pace of the March futures contract roll, and the anticipated reopening of the Shanghai gold exchange following the Lunar New Year holiday. As of the close of business Friday, COMEX registered silver, the metal formerly available for physical delivery against futures contracts, remained unchanged at 88.19 million ounces. No new metal entered the deliverable pool during the session. At the same time, eligible silver inventory, a broader category representing metal held in vaults but not yet cleared for delivery, saw an additional outflow of 1.2 million ounces in a single trading session. Total COMEX inventories continued to register a net outflow even as the registered figure held flat. Meanwhile, silver futures settled the week at $84.57, reflecting a gain of nearly 9% over the course of the week. Gold futures reclaimed the $5,100 level by Friday's close. Both of these moves occurred while China, described by market analysts as one of the largest physical demand engines in the global metals market, remained entirely offline for the Lunar New Year holiday. Adding further context to Friday's close, reports from Shenzhen, one of China's primary precious metals trading hubs, indicated that a major silver recycling company was offering the equivalent of $93 per ounce to repurchase 99.99% pure silver ahead of the holiday break. That figure stands at approximately $9 above prevailing Western futures prices and $7 above Shanghai spot levels, recorded before the exchange went dark for the holiday. When trading resumes on Tuesday, the interaction between Chinese physical demand, the COMEX March contract roll deadline, and registered inventory levels is expected to draw close attention from participants across global metals markets. We will break down the details of each of these developments in full, starting with what the COMEX inventory data actually shows and why the pace of the March roll has become a focal point for the market this weekend. Turning now to the specific figures driving concern in the COMEX silver market, the critical issue centers on the relationship between outstanding open interest in the March futures contract and the amount of silver physically available for delivery. According to the most recently available COMEX inventory data, the March contract carries open interest of approximately 222 million ounces. Registered silver, the only category of inventory that can be directly called upon to fulfill physical delivery obligations, stands at 88.19 million ounces. That gap between what is theoretically owed under active contracts and what is physically available for delivery currently exceeds 130 million ounces. Compounding this imbalance is the pace at which traders are rolling their March positions forward into the May contract. With 4 trading days remaining before the March contract enters its settlement period, only 15 million ounces rolled in a single session during the most recent trading day. Market participants tracking the roll pace have noted that the current rate of transition falls significantly short of what would be required to reduce open interest to levels consistent with available registered inventory before the settlement deadline arrives. It is worth clarifying for viewers what the roll process represents in practical terms. When a futures contract approaches its delivery period, traders who do not intend to take or make physical delivery of the underlying metal are expected to close their expiring positions and reopen equivalent positions in a later contract month. When that roll happens too slowly relative to the time remaining before settlement, the volume of contracts potentially requiring physical delivery can remain elevated. In this case, the math between 222 million ounces of open interest and 88 million ounces of registered silver does not resolve without either a sharp acceleration in the roll pace, a significant increase in registered inventory, or actual delivery demand being met from available stock. On the inventory side, no new metal has entered the registered category to help close that gap. Eligible silver, as noted, continued to decline. Market observers who track COMEX vault reports, which are publicly available and updated on a daily basis, have pointed to the complete absence of new inflows into the registered pool as a structural concern distinct from short-term price movement. The LBMA, which serves as the central hub for the global silver lending market, also recorded a notable event in this broader context. Lease rates at the LBMA escalated sharply after the interdealer lending network, the informal channel through which member banks typically borrow silver from one another, effectively seized. Banks that would ordinarily source silver through private interdealer arrangements were instead required to advertise publicly for silver borrowing. According to documented market records, this development indicated that the informal liquidity cushion within the LBMA system had been exhausted, forcing institutions to seek supply through more visible and less conventional channels. The Silver Institute and structural supply data referenced in market Reporting have confirmed that the global silver market is currently in its sixth consecutive year of running a structural supply deficit. Annual global mine production stands at approximately 800 million ounces. Projections for 2026 indicate a deficit approaching 300 million ounces, a figure representing more than one-third of total annual global mine output. These projections are institutional forecasts and represent expected outcomes based on current supply and demand trajectories rather than realized figures. As we continue our coverage, we will examine the specific sequence of events involving J.P. Morgan, Chinese industrial buyers, and Latin American silver supply that has added another layer to this developing market story. Beyond the inventory figures and contract roll data, a specific sequence of market events involving major institutional participants has drawn attention from analysts tracking the physical silver market. According to documented refining and market sources, as well as reporting by Vince Lancy, publisher of the Goldfix newsletter, a series of transactions between J.P. Morgan, Chinese industrial buyers, and Latin American silver producers unfolded over recent months in a manner that is directly relevant to current market conditions. The sequence, as documented, began with Chinese industrial companies that had spent an extended period purchasing silver during price pullbacks. This pattern of behavior, conditioned by years of suppressed silver prices, left Chinese industrials in a structurally short position when market conditions shifted. When J.P. Morgan reclassified 13 million ounces of silver from COMEX registered inventory to eligible inventory, removing that metal from the deliverable pool, a Chinese industrial entity that had attempted to hedge its short position on COMEX and take physical delivery was informed that the silver was not available for that purpose. What followed, according to the same documented sources, was a short squeeze in which covering orders hit a market that lacked sufficient depth to absorb them, driving prices sharply higher in Chinese markets. In the period that followed, J.P. Morgan reportedly moved to fill that delivery obligation by sourcing silver concentrate from producers in Latin America. Chinese buyers attempting to secure the same material from the same regional suppliers were informed that the supply had already been contracted. One Latin American producer confirmed receiving offers of $80 per ounce from Chinese buyers, approximately $10 above prevailing market prices at the time, because J.P. Morgan had already secured the available supply through prior contractual arrangements. Vince Lancy of the Goldfix newsletter has described the sequence not primarily as a metals market story, but as a proxy conflict, with J.P. Morgan acting in a capacity aligned with Federal Reserve interests and the People's Bank of China operating through its own market representatives, with silver serving as the market where that conflict has been most visibly expressed. Within China's domestic market, additional structural complications emerged. A listed open-end fund in China was reported to be trading at 30% above its net asset value as retail and speculative buyers accumulated positions. When Chinese industrial participants who required lower silver prices to manage their short positions applied pressure to domestic regulators, the fund was transitioned into liquidation-only mode, while silver prices remained elevated. The forced unwind that followed did not produce a sustained collapse in silver prices, as physical demand beneath the paper market structure proved sufficient to absorb the selling pressure generated by the regulatory intervention. In presenting a complete picture, it is important to note the variables that represent genuine headwinds for silver in the current environment. A stronger United States dollar creates mechanical pressure on dollar-denominated metal prices. The Chinese yuan, reaching its strongest level against the dollar since May of 2023, reduces the hedging incentive for Chinese buyers and can affect import premium dynamics. Silver has moved from $79 to $84 within a single session, generated a population of short-term traders, holding unrealized gains who may seek opportunities to take profit. Additionally, supply and demand deficit projections, including the figures cited from institutional sources, represent forecasts rather than confirmed outcomes, and supply responses from producers could alter the trajectory of those projections over time. These factors represent real and documented variables that participants in the silver market are actively weighing as the new trading week approaches. As the global metals market prepares for the resumption of trading following the Lunar New Year holiday, several documented data points are converging at the same moment in a manner that market participants and analysts are watching with close attention. To summarize the key developments covered in this report, COMEX registered silver inventory closed the week at 88.19 million ounces, with no new metal entering the deliverable pool. Eligible silver inventory declined by an additional 1.2 million ounces in a single session. Total COMEX inventories recorded a net outflow even as the registered figure remained flat. The March futures contract carries approximately 222 million ounces of open interest against 88 million ounces of registered silver, leaving a gap in excess of 130 million ounces between deliverable supply and outstanding contract obligations. The roll from March to May continued at a pace that market observers have characterized as dangerously slow, with only 15 million ounces rolling in the most recent single session. and 4 trading days remaining before the March contract enters its settlement period. No acceleration in new metal entering the registered category has been recorded to help close the structural gap between open interest and deliverable supply. These figures are drawn from publicly available COMEX vault reports, which are updated on a daily basis and accessible to any market participant seeking to verify the data independently. On the demand side, silver futures settled the week at $84.57, reflecting a gain of nearly 9% during a period when China, one of the largest physical demand participants in the global silver market, was entirely absent due to the Lunar New Year holiday. Gold futures held above $5,100 over the same period. A major silver recycling company in Shenzhen was offering the equivalent of $93 per ounce for 99.99% pure silver heading into the weekend, representing a premium of approximately $9 above prevailing Western futures prices and $7 above pre-holiday Shanghai spot levels. The Shanghai Gold Exchange is scheduled to reopen on Tuesday. The global silver market is currently in its 6th consecutive year of structural supply deficit, according to data from the Silver Institute and related supply reporting. Annual global mine production stands at approximately 800 million ounces, with institutional projections for 2026 indicating a deficit approaching 300 million ounces. The LBMA interdealer lending market recorded a documented seizure in which member banks were required to advertise publicly for silver borrowing after private interdealer channels were exhausted, an event that has been noted in market records as an indicator of the condition of above-ground available stock within the global lending system. The specific indicators that analysts have identified as critical to monitor in the sessions immediately ahead include the pace of the COMEX March contract roll on Monday, the registered silver inventory figure when COMEX reports on Tuesday morning, and the behavior of Shanghai exchange pricing and premium differentials when the Shanghai Gold Exchange resumes trading following the holiday closure. The interaction between the physical bid inside China, currently documented at levels significantly above Western futures, and the unresolved gap between COMEX March open interest and registered deliverable inventory represents the central unresolved question entering the new trading week. All primary data referenced in this report, including COMEX inventory figures, LBMA lease rate records, and Shanghai Gold Exchange pricing, are drawn from publicly available sources and can be independently verified by any viewer seeking to examine the underlying data directly. This has been a full market data report on the current state of global silver and gold markets. We will continue to monitor these developments and bring you further updates as the trading week progresses. Stay informed, stay independent, and we will see you in the next report.